This is James Walton. I'll just introduce myself and then hand over to Tom. So I'm a qualified actuary at River and Mercantile. I have around 15 years experience in asset liability management in a variety of roles. And I specialize here particularly in derivative management, which is a key topic of what we'll be talking about today. So I'll hand over to Tom.
Sure, and I'm Tom Cassara. Like James, I'm an actuary as well as an investment consultant. I've worked now in the industry for about 30 years. About 29 of those years was with one of the major three consulting firms, and just recently here joined River Mercantile earlier this year. And I have worked with plan sponsors, especially on the DB side, during that period of time, and as ranging, and I've been very fortunate to work with various types of plan sponsors, ranging from very small asset pools to some of the largest in the industry. So with that, I thought we'd just jump in with it. So we're going to talk about de-risking today, and we thought we'd start off by just kind of walking through the landscape of what we have commonly seen being used today in terms of why plans have been de-risking. A little background there, as well as in focusing on what we've seen as benefits, as well as some of the challenges with the current. And then what we'll do is transition into a discussion about ways that we see of improving on that going forward and addressing some of the concerns that are out there today. So switching on to page 4, just to give a little bit of background of why plans have de-risked. We lay out there first, some of the fundamental changes that have come about, and really, if you go back in time, just no new news, probably to anyone on the phone, was, really started with the transition of DB to DC benefits in nature. So moving away from, file average and lifetime benefits to fully funded individual accounts. These plans have, over time, grown to be I don't want to say less important in terms of the balance sheet, but now that people have more or less frozen those plans by virtue of either transition benefits running out or just hard froze them at the time, they now become something to manage on the financials much more so than the people side. And so that has led to the desire to be able to control the impact of those financials on the organization. Also, a fundamental change because of the result of that, if you kind of think about it, is now less people enrolled in these plans. PBGC has had its share of concerns over the viability of the plans and so forth. They've raised premiums over the last year. Well, that has caused now more plan sponsors to realize that there's a cost to being underfunded, and therefore there's a cost to having risk in the plan, much more so than just maintaining a plan. So as you start thinking through that and the implications, now people really have focused much more so on how do I manage my funded status versus how do I best grow the asset pool as an alternative. And so these fundamental changes have really now put more focus on de-risking, but more importantly, trying to really get at, from a plan sponsor, what is most important to the organization. Is it most important to have predictability of costs? Is it most important to try to kind of shoot for the stars and reduce your costs? Is it most important to get rid of the plan as quick as possible? Or is it maybe perhaps a situation where you want to, what I would call hibernate, and have the plan kind of pay for itself, and you're just going to hold the plan until many years out in the future, if not forever. So those are kinds of things that people have now more focused on and shifted away from. And then as far as governance goes, it's now asking yourself, can I implement what my plan is? Can I do it in an effective way? And just as important, can I monitor it in an effective way, and can I make sure it continues to do what I want it to do in terms of the objectives? So we've seen a number of fundamental changes have forced employers to really focus on de-risking, and then obviously as time goes on, nothing gets simpler. So it always gets a little bit more complex and a little bit more finite of what you're trying to achieve. The recent market upticks have been great for all the plan sponsors in terms of the equity run up until the last, say, 30 days. And now many plan sponsors are in much better shape, and they're trying to take this in as well. So we're seeing a lot of reasons of why de-risk, but finally it's about having an action plan and keeping your eye on what you consider to be most important for your organization, what your end goal is. So if we take a step and look at how plans have commonly de-risked, I've broken them here on page 5 into 2 categories, assets and liabilities. Now, no one usually just does one or the other, so it's usually a combination of both in terms of organizing a plan. But here from the assets, common frequent ways of doing have been through liability-driven investing, where you've been reaching to try to take some of the interest rate risk off the plan in terms of finding investment vehicles, most likely long bonds, that best match with the liabilities and move in tandem with them. It's trying to determine what the best balance of what we call hedging assets, which is your as described earlier, the LDI, versus what growth assets for many plan sponsors, the equity bucket. And then a lot of plan sponsors have adopted a glide path, which is just basically saying, here we are today, and as things get better, we're going to go ahead and predetermine what moves we would make so that we don't have to think about it later and have emotion maybe come into play. It's premeditated, and therefore we could capture moments as they occur versus having to discover a moment occurred, call a committee together, and then try to make an effective decision at which time maybe things have changed. The liability side, these are all pretty straightforward, but plans are frozen to manage the size of the liability, and then lately there have been the settlements of the liability, whether through a lump sum offering or through annuity buyouts, which has become popular, especially for retiree groups and those that have small benefits. This has been a nice win for a lot of organizations to help them manage the size of the plan as well as some of the costs associated with the plan. But in the end, we all know why people de-risk. Well, it's better to manage whatever your objectives are and try to have as few surprises and costs. So what have been the benefits of it? Obviously now we've moved away from a pure asset-only investment style to at least being aware of what the funded status and the risk thereof. It doesn't mean you're letting it dictate it, but at least almost all plan sponsors are aware and discussing the impact of risk in terms of funded status and not just in an asset-only context. The prior page, we talked a little bit about plan management strategies. Personally, I think this is one of the best benefits that have come out of it is people sitting in committees deciding, I need a strategy, I need to figure this out. It's a combination of many different things, and let's not only talk about what we can do today, but let's talk about what we would do tomorrow as events unfolded. And I think that having that awareness and that plan has been a great benefit to many organizations. Obviously, the liabilities have been reshaped, as we've discussed, and plan governance has been improved. Whether it's through glide paths or other tools, having more frequent discussions, having more decisions being able to be made quicker. These are all things that have benefited organizations over time. And I like to say, and in some ways, taking some of the emotion out of investing versus having a predetermined plan. And then finally, there's been lower costs of overseeing the plan. Things get run up, you have a strategy in place, you let it play out. There's a lower cost of maintaining it and executing it than there is trying to determine what your plan is each quarter. So those have been some of the benefits, but with the benefits, there's always going to be some shortcomings. Okay? So as people de-risk, and traditionally by moving assets away from equity into more on the hedging side, that can lower your expected return on assets. Fixed income investments typically do not earn the same expected rate of return as equity investments. There's an equity premium that would be paid for those holdings. All organizations will still, unless you're 100% hedged in terms of your LDI or your de-risking strategy, you're still going to have asset and funded status volatility. Okay? If you're still invested in the equity markets can still go up and down unexpectedly on you. Interest rates don't always change for the liabilities as much as the same way as the assets would change, where your hedging portfolio will change. So there's always some risk in terms of managing that. And I have in here potentially longer time to reach end goal. And this is really talking about, for many plan sponsors, as you get better funded, they're going to lower the equity portion of the portfolio. Well, every time you lower the equity portion of the portfolio, the chances of you're going to have less assets working for you in terms of your growth portfolio. And by virtue of that, there is going to be a longer period of time before you get to that next goal. So, for example, if you switch from, say today a portfolio that might be 50% growth and 50% of hedging, and maybe you're 95%, you might have an expected time to reach that 100% hurdle, maybe 5 years or 6 years. But when you get there, you're going to go from 50-50 maybe to 30-70. Well, once you get to 30-70, to get to that next hurdle, that next 5% increase, let's say, if that was the next hurdle, now that might not take 5 years. That might take 7 or 8 or 9 years. So you might actually extend your time period because you're going to have less assets working harder for you in terms of the growth portfolio over time. And so with that, yes, you have less risk, but on the flip side, you're going to have a couple extra years of anticipated administrative costs to overseeing that plan. So once again, the shortcomings tend to be you still have that equity volatility, but as you reduce that equity volatility through moving your assets from A to B, A being growth to B being hedging, you're also going to extend a period of time before the fund increases. So that's a little bit of background. So as we move forward, we have here called the New Frontier, but we've really challenged ourselves to say, okay, for those shortcomings, how can we improve upon the current hedging strategies, the current de-risking strategies, to address both the equity risk issue as well as the longevity issue of increasing the time in a plan so that you don't reduce your rate of return. And so with that, we think we have another tool out there that can help deal with this and help improve on this, and that is what we like to call structured equity. So we'll get into in a second what structured equity is, but just as a kind of a quick refresh, what are the current approaches to return-seeking assets? A little background here. So on pages 10 and 11, we list here 6 different styles, with the last one being the structured equity on page 11. But really, here's what most plan sponsors are looking at. It's obviously equities. I think that's pretty straightforward. There's defensive equities, so some people have looked into otherwise known as low volatility strategies. These are a subset of the equity group, and these are just investing in a style of investing in equities where you're looking more stable organizations that have perhaps a higher dividend, stable earnings, and they're a lower what's called beta than the rest of the market. So they don't tend to move up as much in a growth scenario, but then again, they don't go down as much in a non-growth scenario. Some have moved away from equities, or at least a portion, into bonds and cash. And then on page 11, some are using some type of algorithm or factor investing, sometimes known as smart beta, where you're using some types of rule-based allocation where you're still investing maybe a little bit on a passive side, but taking an active approach to how you're addressing that through different factors and how we go through the economic cycle. With that, some have further diversified their portfolios, looking at use of alternative assets. Most namely, that could be things such as private equity, private debt, could be use of hedge funds, etc., where they can still pick up equity-like returns, or perhaps a little bit more so, but have an investment that doesn't behave the same as your standard equity investments in terms of the correlations and helping to diversify the portfolio, taking some of the risk off the table so that all your assets are moving like for like as the market moves. But what we like to focus the rest of this discussion is talking about structured equity. It's not a new concept in the world, but what we found is that a lot of plan sponsors haven't considered looking at this tool over time, and we think actually that's a little unfortunate because we think it actually fits into investing for somebody who is really looking to both manage their risk as well as still keep a decent amount of expected return to try to help close the gap. We think it's a tool that plays in very well for pension investing, and James is going to go through a little background on it, as well as the application of it in pensions.
Thanks, Tom. So on slide 14, just an introduction to what is structured equity, what we call structured equity. I'll talk later and go through an example of how a pension plan might actually use that and compare it to more traditional investment approaches. But I'll start just by describing what we're talking about when I refer to structured equity. So it is a derivative contract, and I'll talk more widely about derivatives. But that is essentially a contract, a piece of paper that will move up and down in value in some predefined way. In the case of structured equity, the underlying equity index that the value will depend on will typically be a major global index such as the S&P 500 or the MSCI World. And the key reason why this is very helpful from a risk management perspective is the value of this contract at maturity is a contractually defined thing. It's written down on a piece of paper. If the equity market does this, the value of the contract will be this. And that means it's quite powerful as an investment tool to fit in your portfolio, because you can then know years in advance or 6 months in advance or however you want to structure it, what the value will be at a given point in as a function of the equity market. So I don't know what equities are going to do, but using this kind of structure, I can build an investment where I know what the value will be for a given level of the equity market. Unlike conventional physical assets, derivatives like structured equity don't need to be cash settled for the full purchase price. So what I mean by that is I can get $100 of equity exposure without actually handing over $100 of cash to buy that equity. I can just enter into a contract for a very small amount, or potentially even zero, in order to get that exposure. And that's another feature which I'll expand more upon in later slides, which again can be quite powerful from a risk management perspective, and also slotting into the investment strategy of a pension plan. So if I were to enter into a contract that can only ever pay me money out, that can only ever generate a positive payoff, that's essentially like an insurance contract. Your insurance company doesn't come and asking for money if certain events happen. It can only ever pay out, and that would require an upfront premium, and that contract would cost money to enter. We often design strategies where there is no initial upfront premium, but in that case the contract would have the potential to both make and lose money, i.e. fall in value. But the point is there's a wide range of potential designs that we could use, and I'll talk through one example. But the flexibility to both gain more equity exposure than I would otherwise be able to have, or to design payouts that can potentially reduce my risk, again, can be quite powerful. So just taking a step back, so I've mentioned that I'm going to use equity derivatives to reshape my equities, but I thought it would be worthwhile just taking a sidestep and just exploring a bit more what derivatives are and how they're used. They're not necessarily as widely used in pension plans as they could be, or as much in some other countries. But they are very widely used in the corporate world, particularly to hedge balance sheets or P&L. So on slide 15, just 3 examples outside of the pensions world where derivatives are commonly used. An airline wanting to control its cost may use derivatives that are linked to the cost of fuel. A food manufacturer may want to hedge the cost of their inputs, grain and sugar, using agricultural derivatives. And interest rate derivatives, the third example, again can be used to manage many aspects of a corporate balance sheet. So these are very common things. And as an example, just an agreement to buy airline fuel or grains, next month or next year with a supplier, that is a derivative contract. So something that sounds fairly simple, straightforward, part of business as usual risk management, is actually a derivative. So the message is, they are commonly used. It's not necessarily something very complicated that only exists in the world of large asset pools. Just an agreement to buy a commodity in future is technically a derivative. It's a piece of paper that isn't the actual commodity or underlying asset itself. It's just an agreement to buy it in future. So flipping over to the sort of pensions world or asset world, the sort of 3 very common uses of derivatives in where you have financial assets are interest rates, equities, and foreign exchange, rather than the commodities that I gave the example of previously. But the principle is very much the same. We're using contracts whose value moves with reference to these items to achieve a desired outcome and to manage some metric, whether it's the balance sheet or P&L costs, etc. So the analogy between the financial world and the corporate world use of derivatives is very similar. So moving on to slide 17, I'll now talk through an example of how we might use equity derivatives to change the equity exposure that a pension plan has and how that can better manage risk. So to start with that discussion, it's worth just thinking about what do equity returns look like for a pension plan. So on this chart, I'm plotting on the horizontal axis the level of the equity market, and on the vertical axis the return that a passive equity investment would give me. So that relationship is a straight diagonal 45-degree line, i.e. ignoring dividends. If the market were to rise 20%, I would get a 20% return. If the market were to fall 20%, I would get a negative 20% return. So that's the profile, if you like, that every pension plan that holds equities or passive equities experiences. But when thinking about it, that profile is not necessarily the right one to have if I'm a pension plan. Pension plans will target a certain level of return for funding, and they will hope to exceed that to improve funding. But beyond a certain level, equity returns may be nice, but they're not necessarily as valuable from the corporate perspective. In fact, beyond a certain point, if a plan is well funded, very high equity returns may actually not be useful at all, in that the plan may be beyond the level it needs to actually terminate. So there's little extra benefit from equity returns beyond a certain point. On the downside, the bottom left of this chart as well, there may also be certain triggers or pain points that can be articulated or defined. So a certain level of an equity market fall given the current asset allocation, may give rise to minimum required contributions or other pain points. So the point is, when thinking about what the equity market can do, and we don't know what it will do for sure, obviously, there is not an asymmetry in terms of the happiness or utility that we experience at different market levels. Most pension plans, are hoping for strong equity returns to improve funding, but typically we find that the pain, should there be a significant equity market pullback, is significantly would outweigh the benefit if markets were to rally another 30 or 40% from here. So in that context, I'm just going to explore how we might actually reshape that 45-degree line into something different that gives me a profile that may look more attractive, being a pension plan. So I'm going to use equity derivatives, fairly straightforward put and call options, to essentially give a different profile to holding passive equities, and I'll talk through the steps involved in doing that. So what we see on slide 18, I'm going to talk through each of the three steps. Step one is in the top left. So if I start with that passive equity exposure, this 45-degree line, and I consider what my returns will be over 3 years, then that 45-degree line is actually going to go through, going to cross the vertical axis at around 6%, because I would expect to earn dividends from my passive equities. So if the market does nothing, doesn't change in price at all, I would expect a total return of around 6% over the 3 years. So that's the reason the straight line is going through, not going through 0, 0 at that point. Now, if I wanted to actually guarantee that I couldn't lose money over that period, I could use an equity derivative, a put option, to sit on top of my equities, which would protect me against market falls. And that's a fairly well-known strategy to protect against market falls. The cost to do that would be an upfront premium of around 7% of my overall investment over the 3-year period. So I'd have to pay up 7%, but I would then have a derivative, a put option, which would pay out should the market fall beneath a certain level, and my overall investment return over that 3 years could not be less than 0, excluding the cost, the 7%. So the point is, if I'm worried about the equity market, I could protect myself against falls, but there is a cost to that, and I would expect that to be a drag on returns if I were to maintain that strategy through time, and protect my investment returns all the way to 0. So to mitigate that cost and make this profile look a lot more attractive, I'll skip to step 2 on the right-hand side, and I always find this kind of amazing. That I'm going to reduce the cost from 7% down to 2.5%. A material reduction in the upfront premium or cost to enter the strategy, and I'm going to do that by accepting the potential for negative returns over the period, i.e. not protecting my capital all the way down to 0. I'm actually only going to protect it down to a 20% fall in the price level of the equity market. Beyond that point, the protection will cease, and I will begin to participate in negative equity returns again. So this kind of strategy will look like passive equities if the equity markets rise, but I'm always going to outperform and have some cushion if the equity market falls. If it falls below, more than 20% over 3 years, then I'll start to participate in losses, but I'll always be better off having done it. And that strategy will involve an upfront cost or premium of 2.5% over 3 years. So less than 1% per annum kind of running costs to have that protection and peace of mind in place. The third step, which we see a lot of plans do, is to say, well, actually, I don't want to even pay 2.5% as an upfront premium. I want to pay nothing or zero on top of my equity portfolio. How can I do that? Well, I can instead of paying the 2.5%, I can actually forego a level of upside. And the level I would need to give up in order to be able to do that in current market conditions would be to give up returns above a 29% total return, which is essentially accepting you will not benefit from any equity market rises above around 23% price rise. So this is known as a collar, and where we end up on the bottom left is achieving essentially the same returns as passive equities within a range, i.e. between around -6 and plus 23% in terms of what the equity price may be. If the market rises beyond that, my returns are capped off. If the market falls beneath that, i.e. it starts to be significantly negative, then my total return will be zero. If the market falls much more than that, beyond the 20% fall, then my returns can be negative. And I can enter that strategy on top of my existing equities at no cost. I'm sitting with a derivative which will rise in value when the equity market falls, and it will decline in value when it rises significantly, and there's no upfront premium or cost to enter into that arrangement. So pulling it all together just on slide 19, that's the same structure I've just described. I've just shown it in one kind of larger chart, but just to reiterate, I can essentially obtain the same returns I would have on passive equities within a range, but those returns would be capped off above a level and would be subject to protection once the market has fallen a negative up to a 20% fall. So that's an example of perhaps a pension plan is sitting with equities and wants to reshape it to reduce the risk. I'll now talk through how we might use that kind of structure and compare that with a more traditional de-risking approach of selling equities into bonds. So what I'm showing on slide 20, I'm going to look at a pension plan that is exploring 3 investment strategies. The first on the left is a 50-50 allocation between equities and bonds. I'll then look at de-risking, perhaps through a glide path, to 75% bonds, 25% equities, i.e. halving the level of equity exposure, halving the level of equity risk, but the increased level of bonds will dampen the interest rate exposure of the pension deficit. And the third strategy, which is a move to 100% bonds, but I'm going to use equity derivatives to actually maintain my equity exposure back to similar levels to strategy 1 before I de-risked out of equities. So the equity derivative contract that will sit on alongside my 100% investment in bonds will be based on a notional exposure of 50% of my plan assets. So this is this will be a new concept to many plans. What we're doing is achieving the end goal in terms of the physical assets, moving all the assets to bonds, increasing the interest rate hedge, reducing the volatility of accounting measures, and also to the cost of termination, and acquiring the assets we'll need to be in runoff, but without necessarily giving up the expected return that would be normally associated with doing that. And I'm doing that by entering into the derivative, which will continue to provide me with some equity exposure. It's possible to do this kind of structure where the equity piece is just giving me the same total return on passive equities that I may have had before. But what we're going to do is actually combine this with the kind of collar structure that I've just described, whereby the equity exposure is of less risk, i.e. less upside and less downside than conventional equities. So I'll step through a few slides just comparing how these strategies look. The first, just in terms of expected returns. So I've got some statistics up on this page, and just as an example, I've said the plan is 85% funded, 12-year duration, closed and with zero contributions. A simplified example, but perhaps in line with where many plans find themselves at. It will depend on what assumptions you use, but I expect you would get a similar kind of story with a different set of assumptions. We would say the 50-50 equity bond scenario, the first strategy, we would say the expected return of that portfolio might be something like 5.5%. The challenge, of course, with de-risking, conventionally de-risking, selling my equities into bonds to get to the second strategy, is that I'm lowering my expected return, and I said that might drop to 4.8%. I'm essentially halving the level of assets which I would expect to outperform bonds on my discount rate, and so that would fall. One of the key benefits of using the strategy 3 and using derivatives is that I'm really having my cake and eating it in a way, in that we would actually expect we would say the expected return would actually either stay the same or increase depending on exactly on what strategy I've used. In this example, we see the expected return increasing to 6.3%. The underlying reason for that is that we believe the equities you could say would have the same expected return as conventional equities, but I'm holding more in bonds, and in particular in corporate bonds, where I would expect to earn a level of outperformance above treasuries. And when you put all that together, we'd actually expect a bit of a pickup compared to the current strategy. This is an example, and we could look at different, we could have designed things differently to get the same return or slightly lower, but the point is I've got an extra lever in the form of an equity derivative to control the level of expected return that I've got. And what I'm doing is I'm moving between strategies 1, 2, and 3. I'm buying more bonds. So the bottom row of this table on slide 21 is the interest rate hedge ratio, i.e. If that were 100%, I'm completely immunized to interest rate exposure on my deficit. And in strategy 3, I'm buying more bonds. 100% of my assets are invested in bonds. So I've significantly increased that hedge ratio and reduced my interest rate risk. So what I'll talk about now is just go through some equity scenarios and compare the strategies on slide 22, just to demonstrate the potential impact on equity risk. So what this chart is showing is the projection of funding level in a variety of different equity market scenarios, just equities up and down by certain levels over 3 years. So focusing on the left-hand side, the current allocation, this is the 50-50 allocation. I would expect if equities were to return something in line with their long-term historic assumptions, something like 7% per annum, I would expect the funding level of that plan that was 85% funded to improve to around 87%. But if the equity market were to rise above that level or fall, then there's significant variability due to equity markets in the projection of that funding level. So these different dots are just the same projection, but with the equity market doing different things, all else unchanged, no change to interest rates or credit spreads. If the equity market will return 60% total return over 3 years, the funding level would improve to 105%. So that 50% allocation to equities would rise significantly in value and effectively eliminate the deficit over that 3-year period, albeit a 60% total equity return is fairly unlikely. Conversely, there's a lot of downside if you're holding half your assets in equities. If the equity market were to fall over 30%, if the total return on equities was negative 30%, I'd be down at 65% funding level. Compare that with the second strategy where I have half the level of equities. Essentially, these dots just compress to half their distance. There's less variability because I've got half as much equities. In that case, if the equity market were to fall by that sort of 30% level, I'd be down at 74% funded. So a significant drop from where I'd expect to be, but still much better than 65 because I'm holding half as much equities. Conversely, by selling out of my equities, I have limited my scope for upside, and in the expected scenario where equities outperform bonds, I would actually be at a lower level than I was previously. So this is in line with what I described on the previous slide. My expected return in my central set of assumptions would be lower as I de-risk from equities into bonds. Now the final strategy, using equity derivatives, kind of looks visually fairly similar to the second, i.e. the range of outcomes is significantly compressed compared to the first. And that's because I'm using this kind of collar shape that I described earlier, whereby I'm gaining equity exposure, but that's capped at a certain level, and it's also has less downside and less risk should the equity markets fall. So using that same structure I talked about, where my total returns would be capped at 29%, I would actually be capping off my funding level at around 93% in this example over 3 years. However, on the downside scenarios, I'm only at 72%. I'm not down at 65%, so I've achieved some level of protection. In the kind of middle scenarios, if the equity market were to return 7% per annum, I'd actually be slightly better off than under my current strategy, and certainly a lot better off than if I de-risked the 25% equities. So the point is, I can maintain my overall level of equity exposure, expected returns, maintain or in this case slightly improve outcomes if the equity market performs around kind of central expectations, but for no cost, by giving up some upside, I can achieve some level of downside protection. And this kind of profile will be attractive to plans who find their current level of equity risk perhaps uncomfortably high, but they don't want to sell the equities and forego that driver of returns that they're relying on to get them out of deficit over time. Slide 23 is just the numbers behind what I've described. I won't talk through this in detail, but the one point from this slide which I didn't talk about on the previous one is that you can do the same kind of scenarios with interest rates, and the final strategy where I've moved to bonds and equity derivatives will be a lot less sensitive to interest rates. Again, less scope for interest rate rises to help, but also significantly less declines in funding level should interest rates fall significantly because of those extra bonds that I'm holding. So I'm going to take a pause and hand back over to Tom. He'll talk a bit more about how this kind of strategy compares to glide paths.
Right. So you can take the same logic and you could insert it into your glide path. Once again, glide paths are prearranged, whether they're in writing or not, of what you're going to do as future events come up, whereas your funded status improves. The typical one here is shown at the top of the page, where maybe you go from a 50-50 portfolio at 85% funded up to being 100% in fixed income once you get to 105% or wherever your target may be, and you're de-risking, and either you'll hibernate the plan or go buy annuities from an insurer at that point. Once again, there are two key challenges with these paths. One is you still have the equity risk, as we saw just in the previous 2 pages, that even at 50% allocation, equity markets go down, you're going to go down, at least for half your portfolio, for that amount. And as you go up your glide path, or as you get better funded, you're going to have less and less growth portfolio working for you. And we saw that in the prior example where, if you compare that 50-50 portfolio to 25-75 portfolio, at expectation, a 25-75 portfolio didn't really improve the funded status, it just maintained it. It just brought in the tails. And then if you compare it to the portfolio next to it, while it brought in the tails, it also raised the expected return, so it had more assets working for it to get you to that next hurdle. So what we've done is we've used this strategy and modeling out and inserting it into glide paths. And really at a high level, what we're really talking about here in terms of your glide path isn't necessarily moving away from wherever you're comfortable in your current allocation, whether it's 50-50 or a 40-60 or a 60-40 portfolio, but it's taking that structure, as James had defined it, which is that collar, and putting that collar on top of that 50, whether it's done, as we showed here, synthetically or as an overlay. And then as you improve your funded status over time, you can start to sell off more upside to buy more downside and take that collar and actually start to shrink your range of returns, thus providing more predictability, but yet, and this is where it's most important, still having a good amount of assets working for you to get to that next trigger or to that next hurdle. And when we've modeled it and looked at this, we can see that there probably is a couple of years of savings in terms of time to get to that fully funded status by doing it this way versus doing it what we'll refer to as a traditional approach. And obviously every year that you cut off and get there without having to contribute more money is also a year of saving all the fees associated and all the complexities around administering a DB plan. So to us, there's a lot of benefits here. We think glide paths have been terrific up until, well, they've been terrific, but they have these 2 major concerns, and we think this really mitigates those 2 concerns in a very efficient way. So, well, I don't know, James, I think we either did a really good job of describing it, or our audience is still fascinated with it. But so we're looking for some questions here, but what we did is, here on page 25, we put together some frequently asked questions. Obviously, we're going to take any questions that the audience has as well. So maybe, James, perhaps maybe tick down a couple of these. But I think a lot of investors always see, well, at least I think in talking with a lot of different organizations, there always seems to be this is a complex, this is really only for the super jumbo plans. Wonder if you could address, is there a minimum amount? Where do you see the market in terms of how big of a plan to be effective?
Yeah. So there's not really a minimum size to do the most sort of basic type of equity derivatives, which would get a lot of the benefits that we've just described, i.e. you could move into a higher bond allocation and retain some equity exposure synthetically using a type of derivative which would be exchange traded, to use the jargon, and that's essentially accessible to almost any size without any kind of lower limit. To do the kind of bespoke shaping that we described and maintain kind of a lot of bonds and treasuries would require a more bespoke agreement, which I call over the counter, and the kind of minimum size for doing that kind of route would be something like 30, 40, 50 million dollars. But the message is you can do fairly simple stuff at small sizes and get a lot of the benefits that we've just described.
Okay. I know one of the other issues we've come up against is the risk of derivatives. There always seems to be concern that that the other party won't pay. Similar to perhaps I'll liken it. You actually this is probably a poor analogy, but you make a bet with somebody and then they don't end up paying the bet, right? But I think that's come a long way in terms of managing collateral. Maybe take a second walking through that.
Sure. So I guess just to expand a bit more on what Tom's kind of getting at, we didn't explore a lot of the plumbing in the presentation behind that. But if I enter into this contract, that's going to go up or down in value. If it goes up in value to me, then the bank who I made the contract with owes me money, and I don't want to be in that position. So very standard kind of processes are in place to all but remove that counterparty risk, and that's called collateral management. So collateral is cash or US Treasuries, and every day as the value of that contract moves up and down, cash or US Treasuries would be moved between the plan and the investment bank, therefore essentially removing a lot of that risk that Tom described.
Mm-hmm. I think another common thing I hear is about, once I enter a contract, especially if I sold off the upside over a certain period, in the examples we saw 20, I think it was 29%, if the market goes up, then I'm giving everything up above it, and over a 3-year period, if the market really is on a tear, then I could lose. And I think in reply to that, I don't think people always realize that these contracts can be resold on the market where it effectively canceled. And in fact, many organizations don't ever hold the contracts until the final term period. To give you a great example is if we bought a contract that sold off the upside above, I'll keep consistently with the 29%, and the market was up 28 after 2 years, we'd have to ask ourselves, is it a good deal to keep this contract to earn maybe 1% more, but still have 28% down before the back end of the contract pays off? And I think we all would agree, mathematically, that may not be a good contract to keep, and we would look to the market to sell that contract and perhaps then re-enter or roll into a new contract establishing a new starting point. So I think that's also a common misconception, that these things aren't, while they're contracts and they're set, there is a market price to them. They can be exchanged. It doesn't mean if the market goes up 50% and you sold off 29, you're going to lose 21. And I think that's a common misunderstanding, or at least maybe not clearly understood across of it.
Yeah, that's a good point, Tom. And we've had a pension plan client who's had this kind of collar on for about 4 years. Equity markets have gone up and up, and they got to the point where they were at that kind of cap, and we worked with them to kind of reset that. So throughout the past 4 years, they've had fairly close to equity returns, but knowing that if there's a big pullback, they would have some protection, and that level where that protection kicks in has just been shifted up as the market's gone up. I guess I'll ask Tom a question. You know, I guess when we've kind of talked through how this looks from an ALM perspective, it all looks attractive. I guess what are the downsides or potential areas of regret? You know, if I'm a plan sponsor, why may I regret having done this kind of strategy?
Well, I mean, there could be, you know, obviously with anything, there could be market scenarios where, you know, where maybe perhaps not doing the strategy would have been better, right? So one of those scenarios could be if interest rates were to rise, and in the current method where you only have 50% of your assets allocated to fixed income, if interest rates were to rise significantly, then your liabilities probably would most likely decrease much faster than that half of your assets would decrease, and so your funded status would improve by that function. With that said, I think we saw in a couple pages earlier that here you still would benefit from the interest rate rising. You wouldn't benefit as much. But if you did have a view that interest rates were going to rise, you could structure your underlying physical assets in such a way to benefit from that rise as well. So it's not all guaranteed, but that would be a scenario where there might be some regret risk. The other scenario would be, you know, obviously if equity markets were to rise and rise fast, without the collar, you would obviously be somewhat better off. I go back to the original conception here, which was there's a certain point where assets are not useful above a certain point in a typical pension plan, where being 110, 120% funded is actually just going to, if it's a frozen plan, is going to be an excise tax situation for most plan sponsors with that. So yes, there are economic scenarios where you would have some regret risk. I would argue that they could be mitigated if there's a view on the markets, and I would also argue that you would still probably have a benefit by being in the structure. You just won't have the same amount of
Wonderful.
benefit
Thank you so much, gentlemen. I'm not sure
And
if
I
you
just
saw
expand upon that just to make
the question
kind
that
of
came in regarding
overarching
the fees for
kind of
managing the
comment.
collateral and
Yeah,
monitoring
we've gone
the
into a lot of
structured
detail here, but I
equity
would
product.
say derivatives and
You guys
structured
see that
equity
one?
are just another tool to help you change the level of equity risk or interest rate risk you have in the plan. And that conventional tool has just been to physically move your assets, and by using derivatives, it just gives you more options to alter that exposure to achieve your objectives.
So I'm seeing us right 2 minutes before 3 o'clock, so I'll reach out if there's any additional questions coming in. But otherwise, I think we'll turn it back over to the team at UCS.
Wonderful. Thank
Yeah,
you.
we did not see it, but we're happy to address it. Jay, you want to talk about the fees?
Yeah, so you would need to pay a fund manager to manage
I think that brings us right to 3 o'clock. So thank you everyone for joining us.
The manager is doing
we will look forward to seeing you at another webinar in the future or one of our conferences next year in 2019 where you can meet River and Mercantile in person. And hope everyone has a great day.
Those
Thanks
kind
so
of
much.
fees would be, I would say, between sort of 10 and 20 basis points.